Hello everyone and welcome to Business Hub. Investing using compound interest is one of the finest strategies to increase your money. The best compound interest investments currently on the market are listed below if you're wondering what investments contain compound interest. Investing in compound interest involves purchasing short or long-term money market or bank-type assets. As the investment grows, it adds additional money to your retirement fund. In this video, we will take a look at some of the best compound interest accounts and compound interest investments to hold in them. Number 10. Cryptocurrencies. Bitcoin and other cryptocurrencies are relatively new forms of investing that have experienced rapid growth in recent years. Blockchain technology is used by cryptocurrencies to operate instead of relying on centralized organizations like banks. Cryptocurrencies are a desirable alternative if you want anonymity and security in your investing because of their decentralized nature. Cryptocurrencies have the drawback of being extremely volatile. For instance, it has been documented that the value of Bitcoin can change drastically in a matter of hours. This is something you should keep in mind before investing any money in cryptocurrencies, and you should only do it if you feel comfortable taking on the associated dangers. In the end, investing in cryptocurrencies can diversify your portfolio while posing a high risk and possible profit. Number 9. Real estate investment trusts. With the help of real estate investment trusts, or REITs, you can invest in real estate without having to buy a piece of real estate outright. For those who want the advantages of real estate ownership but lack the time or resources to manage their properties, a model like this can be a great solution. REITs invest in diverse types of real estate by pooling money from numerous different investors. Residential real estate, apartment complexes, office buildings, and commercial centers are all examples of investments. For those wishing to diversify their portfolio, REITs are a desirable alternative because they provide direct access to a variety of assets. As with any pooled investment, a drawback is that you lose control over the particular properties in which your money is invested. Number 8. Real estate. Investments in real estate have been around for generations. Over time, it may be a fantastic method to accumulate wealth. Direct ownership of real estate or pooled investments like mutual funds, ETFs, etc. are the two ways to invest in real estate. If you want a hands-on approach and long-term stability, buying and holding real estate directly can be a fantastic solution. Direct real estate investment entitles you to ownership of the property. It's crucial to keep in mind that owning a home requires extra work, from locating qualified tenants to managing repairs and maintenance yourself. Let's say you'd rather invest in real estate without really owning any of it. Pooled assets like mutual funds, ETFs, REITs, or crowdsourcing platforms can be excellent choices in that situation. With these kinds of investments, you can invest in larger portfolios that expose your funds to a variety of properties all at once. Number 7. Alternative investments. Any investment that is not made in stocks, bonds, mutual funds, etc. is considered an alternative investment. In other words, equity investments or non-stock investments are largely off-limits to retail investors. They may consist of hedge funds, small business investments, venture money, and even collectibles. Due to the possibility for larger returns, alternative investments are popular among investors. In comparison to conventional investments like equities and mutual funds, they also carry higher risk. Although it can be difficult to forecast how much money you can make or how liquid the investments will be, alternative investments can be alluring. For individuals just starting out, more conventional assets like dividend stocks or mutual funds are a better choice. Only those new to investing should think about alternative investments if they have additional cash they can lose. Number 6. Mutual funds. In mutual funds, which are professionally managed investments, money is gathered from a number of different investors to purchase stocks, bonds, or other securities. Like individual stocks, mutual funds are traded on stock exchanges, and their prices move throughout the day. Mutual funds, on the other hand, include several companies, as opposed to stocks, which reflect ownership in a single company. The assets of the fund are additionally actively managed by experts who make investment decisions. Mutual funds are frequently regarded as a great compound interest option for starting investors since they provide professional oversight. For this service, mutual funds often charge a fee. Depending on their structure, they might also be charged annual management fees. Number 5. Exchange-traded funds. A type of investment known as an ETF follows an index, such as the S&P 500. ETFs track changes in the index's value, which is reflected in the underlying value of your ETF. During regular market hours, ETFs can be bought and sold on the stock market, and many brokerages provide commission-free ETFs. These accessible, low-cost investment vehicles are a well-liked option for novice investors. ETFs come in a wide range of varieties, some of which concentrate on particular economic sectors or geographical areas like Europe or Asia. ETFs are a well-liked investing option since they provide diversification and allow for quick buys and sells. Number 4. Individual stocks. When you purchase stocks, you own a portion of a firm that, ideally, will grow in value over time. This effectively means that your investment increases together with the firm. Some stocks may entitle you to dividend payments from the company, providing you with a quick return on your investment. Frequently, you have the option to have those dividends reinvest themselves automatically, allowing your investment to expand over time. The value of a stock cannot be guaranteed to rise. Investments in stocks can be risky, particularly in uncertain economic times. However, if you want to start stock investing, using an app that gives free stocks to new customers is a great place to start. Number 3. Money market accounts. An alternative to a normal savings account is a money market account, which pays a higher interest rate. In comparison to other short-term assets like certificates of deposit or treasury bills, they also provide better liquidity. The fact that MMA interest rates are often lower than those of other investment options is a drawback of M&As. Therefore, they might not produce considerable compound interest like other investment options on this list. The minimum balance needed to keep the account open is another issue to be aware of with M&As. Some banks demand that an account maintain a minimum balance at all times. The bank may impose fees if the balance falls below this threshold. Number 2. High-yield savings account. Another choice for short-term investments is high-yield savings accounts. Although these accounts have higher interest rates than conventional savings accounts, they often have the same liquidity as cash deposits. The fact that interest rates can alter is one drawback of a high-interest savings account. Be aware that even if you first receive the best interest rate offer available, your rate may decrease. For instance, numerous banks lowered the interest rates on their high-yield savings accounts during the course of 2020. These kinds of things frequently occur when the economy is struggling. Therefore, it's crucial to pay attention to the rates that banks provide. Before registering for an account, make sure you are aware of all the expenses involved. Number 1. Certificates of deposit. Most banks and credit unions provide certificates of deposit, which are simple to open and comprehend. In the US, CDs are insured up to $250,000 and are almost risk-free. Similar to savings accounts, they are another type of savings instrument, but they have longer-term obligations that can last anywhere between 3 months and 5 years. You lend money to a bank for a predetermined period of time, with longer terms often carrying higher interest rates. The longer the term length or commitment, the higher interest rate and return you can expect to earn in exchange for having less access to your money for a longer period of time. Much like any interest-bearing asset, you earn interest on the principal during the term at a rate that is typically higher than a high-yield savings account. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.